So welcome everyone to this interview series. My name is Christina Theodoraki. I'm editor of Small Business Economics and Entrepreneurship Journal. And I have the great honor to interview today Regan Stevenson, who is assistant professor at Kelley School of Business in Bloomington. And he's here with the associate professor, Chaim McMahon from Law School of Business at Elon University. Today we have the great pleasure because both of them, they are going to present their insights about their article published in Small Business Economics, and it's also available in open access. The article is entitled Entrepreneur Fund Seeking Toward a Theory of Funding Fit in the Era of Equity Crowdfunding. So welcome both of you, and we're happy to host you in this series. Can you tell us more about your article and co-authors?
Absolutely. Thanks, Christina, for having us. So this article is published with myself and Sean and two other co-authors as well, Mike Ciuchta and Chaim Letwin. And what we were trying to do in this paper was just kind of at the broadest level, we wanted to ask this general question: why do entrepreneurs prefer to seek one equity funding form over another? And we used the catalyst of equity crowdfunding being introduced in the United States, which happened in 2016, to kind of explore this question qualitatively. And as it became known that this was a new source of funding for entrepreneurs, some initial research started around this idea that perhaps this equity crowdfunding is just what you would do if you had no other options. So it's kind of this funding mode of last resort for discouraged entrepreneurs. But between Sean and I, we and our other co-authors, we talked about, well, what situations or when and why might a strategic entrepreneur or a highly capable entrepreneur actually want to seek this type of funding. So in this paper, we try to unpack, why highly capable entrepreneurs might prefer equity crowdfunding over other forms of funding. And then we extend our analysis there to come up with a theory of funding fit as to why and when entrepreneurs might want to seek different forms of funding.
Can you specify why this article is important, or probably give us an explanation of the funding fit?
Sure. Well, I'll start off here and pass to Sean as well. But previous research, as I kind of mentioned, tended to focus on, when you're thinking about fund seeking, these like highly calculable ways or these kind of rule-based formats or theories that entrepreneurs would use to select their funding. So things like transaction cost economics or the pecking order theory. So these were almost formulaic types of approaches that you would use to think about how and when you might seek funding. And what we were trying to get at here in this paper was that it's really, for certain entrepreneurs, it's really much more about fit, depending on how many resources or which types of resources, depending on what types of strategic resources you're seeking, that's going to drive your decision to seek a different type of funding differently than, say, just what you can capture from the marketplace, right? So that's a little bit about how we kind of move the needle on the theory or start to move toward a theory of funding fit. Sean?
Yeah, I think what was interesting, the phenomena of ECF arriving provided, for Regan and I, we both have entrepreneurial backgrounds, but we're scholars. And so that provided sort of a live market basis to test an idea, or at least explore it. To a certain degree, the funding environment has been sort of a seller's market, right? Entrepreneurs went and talked to wealthy angels or VCs or corporate venture capital. And it was kind of self-evident that they, to a certain degree, could dictate the terms of funding. And so when ECF came along, it seemed like, well, there were certainly entities that were unable to raise money from angels and unable to raise money from venture capital. And so there was this sort of notion that, well, it must have been all the folks who were rejected that would just sort of coalesce in this mass market and potentially even rip off or trick people who didn't know better or didn't know that they weren't good startup ideas, because all the professionals had turned them away. So we had sort of a conceptual reason to think that was short-sighted, but before ECF, there really wasn't a great mechanism to test that. So I think in terms of contribution, we had sort of a set of thoughts but no way to really look at it. ECF really allowed Regan and I and Mike and Chaim to kind of say, okay, well, let's start gathering data and see what entrepreneurs, how they react to this sort of situation that's arisen.
Great. I think every article has a history behind. Can you tell us more? Where did you get the idea of this research? What was the history behind, or why, from what you have been inspired to shape it in this article?
So yeah, originally this actually started in a doctoral seminar. So the idea that equity crowdfunding was going to become legal, we actually started thinking about this concept a couple of years before it did become legal. So we actually had no data to test. So it started as a theory paper, and wanting to bounce ideas off of somebody that had been there, had done this before in terms of funding. Went to Sean and we started discussing different theories or different ideas around funding fit. And Sean?
Yeah, it's fascinating, Christina, because Regan and I, we both had startups, mine in the US, his in Canada, in different decades, in different industries, by different funding means, both with exits, but different types of exits, right? So that's only a sample of two, right? Not a big sample, but as a phenomena, it was interesting because despite all of those differences, we had immediate agreement that we ourselves preferred and actually did find our funding, not by going to the typical sort of assumed venture capital. And we seem to, it was almost hard to explain why, right? We had not thought about it through all the theoretical boundaries, but to us, the pecking order did not make sense, at least for us. I think it's a valid theory for lots of situations, but the sort of transaction cost economics, make versus buy, Regan and I were in immediate agreement that we ourselves would rather raise the money with as few strings attached as possible for the type of startups that we had. And we could see that there were cases that would make sense for other people. And ECF was something that we would have loved to have had been in existence when we were going through ours. So we saw it as a real opportunity to kind of lay that out. But when you're doing science, you can't just tell two stories, right? You have to sort of gather a lot of evidence and remain objective to your own thoughts and ideas. And so it was kind of really amazing to gather all the information on this first cadre of firms that used WeFunder, and see what they had to say. You have thoughts on that, Regan? About?
No, I completely agree. I mean, our thinking evolved so much because at the time it was really a theoretical proposition that equity crowdfunding would be this new form of funding, right, where amateurs would be allowed to fund, and there would be a systematic way to facilitate that transaction, presumably for more efficiency and things like that. And then what we found and we discovered was one of the things that drew entrepreneurs to it was those efficiency considerations, those financial considerations, but also the non-financial considerations, things like the ability to have a little bit more strategic control, the ability to maybe make decisions that weren't based on how do we get to the 5 to 7 year exit as fast as possible and recoup the largest amount of money possible for our investors. Instead, thinking about things like, how do we add value for the community of users that we're going after? How can we leverage those users to give us insight so we can learn from the crowd through the transaction? How can we embrace those users so that they feel like they're evangelists for our brand and they can go out there and talk to many, many of their friends? So these are all things we discovered along the way that, of course, weren't really in existence prior to the rise of equity crowdfunding. It doesn't mean that equity crowdfunding is the be all end all, and it is always the first resort, right? But for certain entrepreneurs that might already have some of those strategic connections or some of those managerial competencies, these other demand side characteristics actually can shift their view so that they prefer this type of funding.
It's a great and very inspiring also to see that we have this financial outcomes, but not only, and we have also this qualitative outcomes that can have for the society or even the company. based on your expertise and your findings, can you tell us more about where do you see this research topic going forward? Or do you have any new ideas or new focuses you are interested to explore?
We have a couple things underway. I think, you know, we, as former practitioners, there was something that was unappetizing about the idea, because we've been there, right? I didn't like this notion that ECF is just for the folks who couldn't find money elsewhere. I think a market is well served with lots of nodes along a continuum, and I think that Regan and I have talked a lot about that. Like, it isn't just that a particular entrepreneur at a particular point in time might choose ECF. It's actually that there's a really elegant spectrum, sort of a theoretical framework, where, at least conceptually, there is an appropriate funder at a point in time. Now, obviously, it's a two-sided agreement, so the funder may not agree. You might feel like you need corporate venture capital because you're doing something pharma related, right? Very highly specific, highly technical, as opposed to sort of retail apparel, where you just need to find customers and have people who like your brand. That doesn't mean the corporation that's looking at your new pharmaceutical idea wants to invest in you, but at least at a conceptual level, there might be different nodes along that continuum. So I think, Regan, maybe that makes sense to talk about as some of the ideas about how do we build out from this initial small sample that we looked at qualitatively.
Yeah, so we looked at a small qualitative sample. Obviously, there's limitations to that, but we've kind of proposed or moving towards this idea of funding fit. And we think we can extend that, and others can extend that. And perhaps some of the recent technological and societal disruptions actually will impact that even further. So re-examining some of the classic theories, and then thinking about how society and technological shifts might change that a little bit. I mean, these are ideas we're thinking about. Of course, equity crowdfunding, but perhaps into other funding modes as well. You've got new modes like SPACs that have just emerged, and others, and trying to understand how, as Sean kind of said, what this looks like conceptually along the spectrum of different funding modes that are out there.
Can you tell us more about how your findings and results can be applied, or can you give some advices from experts for people that want to implement or apply your results?
One initial thought, Christina, is just the idea that, and this is sort of a metacognitive notion of who is in the conversation, right? So when Regan and I first began to write about this, some of the feedback we got was sort of I think there was sort of a move of investment banking mindset into the scholarship around funding. And it was sort of like that was the loudest voice or the biggest voice in the room. And I think it's always interesting. I guess I would say it's an entrepreneurial mindset, and we do entrepreneurship research, right? So I think it's interesting to say, well, it should be a natural notion of the entrepreneurial mindset to make sure you have a 360-degree perspective. And so I think that's been interesting, where hopefully we've initiated or helped with the beginning of a conversation that looks at the other side of the table as where entrepreneurs are making choices and what research looks like. Because, different silos of research are going to focus on finance first plus an entrepreneurship topic, or entrepreneurship first plus a particular finance situation. And that's reasonable, but it can also have limitations, right? So it's important, I think, for scholarship to remain entrepreneurial itself in order to be able to have some of these conversations. So that's one thought I have that's been fascinating with this.
Yeah, completely agree. And just another thought that's related. If from a practical perspective, if you read our paper, there's a lot in there, and one takeaway might be, when you're thinking as an entrepreneur what type of funding you want to go after, think beyond simply the funding, the actual capital itself, right? Think about the other things that come with the capital. Some of those things are good, and some of those things can be bad for you, right? So in terms of loss of strategic control, or potentially the opportunity to partner with others that have experience in your industry, or to create a community of users that become brand evangelists. So really think about these non-financial factors that come with the funding itself. And frankly, it's not that common that entrepreneurs that I deal with, young entrepreneurs, new entrepreneurs, are thinking about that. They just want to find the funding as quickly as possible and use that funding to launch their business. And, you know, taking a step back and thinking about these other factors can really be helpful at that stage.
Thank you very much for your insights. It was a great discussion, Regan and Sean. Thank you for sharing your insights with us. The article is free download from the website of Springer in Small Business Economics. So thank you again for joining us and sharing your insights in this interview series.
Thanks so much for having us.